The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Thank you, disembodied announcer voice. Welcome to Volatility Views. Indeed, the premier program for all things volatility. As the man said, my name is Mark Longo from the OptionsInsider.com, as well as the old Options Insider Radio Network. And I am joined today by the yin to my yang, good old Don Schlesinger from the Volatility Exchange. Don, welcome back to the show, sir.
Always great to be here, Mark, and I'm warning our listeners in advance if I sound like a croaking frog. I've been fighting a cold that seems to have settled in my throat more so than nasally, so a little bit raspy today, but we're going to do our best.
It gives you an extra bit of gravitas, Mr. Schlesinger. And, of course, we will be joined later on by a very special guest in our Volatility Viewpoint segment, as well as the regular volatility opinings of one Mark Sebastian later on in the program. But we're going to kick things off right now with our Volatility Review.
It's time for the Volatility Review.
And welcome to the Volatility Review. This is, of course, the portion of the show where we sit back and parse and analyze the week's worth of volatility action. And if you're looking for a week of volatility action, you could do worse than looking at this past week. It's certainly been an intriguing one, to say the least. Wouldn't you say, Don?
I tell you, every week that I say this type of stuff can't keep up, and obviously we're going to eventually settle down to what we would refer to as a more normal level. The market just keeps putting in these crazy days, one after the other, so who knows where it stops.
Yeah, it's definitely one of the stranger weeks, I think you could say, in the history of the VIX and the good old VIX cash. Of course, we've been talking on this program for quite some time about, in fact, on last week's program, about the possibility of the VIX and people being essentially fully insured. We saw people in the previous weeks really gobbling up some near-term downside in the SPX, and it seemed like people had really somewhat insulated themselves against some of the near-term shocks in the index. And of course, we also talked for a while on this show about the possibility that indeed the probability that the VIX was well overpriced, and that these levels were unsustainable. And in fact, quite a bit of the professional paper we've been seeing in VIX for months now has been to that effect. People have been betting heavily to the downside in VIX for a very long time, and quite frankly being frustrated for a very long time because the VIX continued to go north or remain at those unsustainable, quote-unquote unsustainable levels for a very long time, stymieing many people for months. And some of the more, let's say, stubborn among them would continue to roll those bets and roll those short bets. And if you were amongst those stubborn ones, you finally saw some of that start to play out this week. And it's been an interesting week, as we said. We saw a lot of people diving into the fray, debating what exactly was going on with the VIX this week, because it was one of those crazy weeks where the VIX seemed to be moving primarily in lockstep with the broad market as opposed to inverse of it. And we saw that particularly spelled out in some days. We had some relatively strong sell-offs in the broad market and equally strong sell-offs in the VIX. And of course, that ain't the way it's supposed to happen, at least if you believe all of the marketing materials. And, it's been interesting if you've been watching this for the past week or so, just exactly all the different people voicing their opinions, and it's been written about in every single outlet you could think of in every single area. And so it's interesting for us to kind of just bring it all to a head here as we discuss this. But of course, we've been talking about it for quite a while, and it really, like I said, there are multiple points of view. Are people fully insured? Is it a question of it seems almost done, and maybe I'd like to see your take on this as well. It seems to me somewhat, we talked about the fully insured concept last week, and it was a novel concept. I'm not sure if any of us fully agreed with it, but it seemed interesting that people could be somewhat insulated to the downside so they weren't reacting as adversely to these market shocks. But it seems almost as if, even though we've been talking about it and everyone's been talking about it for months, the market suddenly came to its senses this week and realized, you know what, these really are unsustainable levels for the VIX. We're not moving 2+% a day. It really should be dramatically lower, and they just drove it to the downside. Is that what you saw as well?
I happen to agree with that, and I think we touched upon it last week. These 32s, which 2% a day, or with the VIX at S&P at 1,200, you're looking at 24 handle moves every day, is not the reality of the market. Not that we haven't had many volatile days and perhaps more than our fair share, but it's not the norm and it's not the reality. So now, you get down to 24 and people are saying, wow, look how low, and a break in the VIX, as if 32 were normal, but 24 is 1.5 times 16, which is 1% a day. So 1.5% movement on a 1,200 index is 18 handles a day. And I think you're right. I think people have just said, look, hey, even if we move 18 handles a day, wake up and understand that that's 24 volatility. That's not 32 volatility. And maybe we simply slide into a different regime. I read something is actually posted on your Options Insider Network where Bill Luby wrote a piece about the seasonality of VIX, and we had Larry McMillan discuss it a couple of weeks ago, where he mentioned something that I found quite extraordinary, actually. I haven't done the research, or I'll trust his data, but he said that historically over time, VIX has reached its low point for the year 40% of the time during the month of December. If I read that correctly, and that's true, that's really an extraordinary statistic, given that there are 12 months in the year.
Yeah, that's
and that
fascinating.
Any one month represents, a little over 8% of the time in a year. For VIX to hit its low on a yearly basis over time, over many years, 40% of the time in December is absolutely extraordinary for a seasonality. And Bill kind of postulated as to why that might have been. And of the couple of arguments that he tended, I think the one that to me makes the most sense is simply that traditionally December is an extremely strong month for the stock market. It's one of the strongest up months if you break price movement into, what the market does during a particular month. Most of us know that November, December, January are very strong up months historically for the equity markets. And so I would expect that there'd be somewhat of a disproportionate drop in VIX during a month like December because of the inverse correlation. If the market is going to perform well, which it often does in December, then you're going to get that opposite effect with realized volatility dropping and therefore implied volatility dropping as well.
Yeah, that was the other proponent a lot of people put forward for why the VIX was coming off. It was somewhat of a perfect storm combined with the paper flow, combined with the market perhaps coming to its senses, was also the third bit of that mix. There was the winter Christmas doldrums, which I'm sure play off into what Bill is talking about as well, the seasonality of the VIX. You combine the general uptrend of the market in this time of year with the fact that most professionals this time of year are taking their ball and going home for a little while and taking their money off the table. All of that could be combining to have this quote unquote perfect storm for VIX, where it really just all came to a head and it all came off despite what was going on in the broad market, which was actually some volatile and some serious down days. We still saw all of this just coalescing at once in the VIX. So if you've been waiting, you're one of these guys who's been loading up on VIX puts ever since the debt debacle debate began several months ago, and you've been rolling every month. Hopefully this week made it up for you. And of course, we do cover the broad spectrum of volatility products on this show, including the good old vol contracts for the euro. And Don, it's been an interesting time to be active in and around the euro these days as well. So let's look at some of the activity we saw over the past week in the euro vol contracts.
Well, what was interesting was we had an expiration coming up last week. We actually recorded on the day of the expiration, and we kind of guessed that the front month, December, would go out somewhere in the mid-12 range. And in fact, it went out all the way down at 11.12. So obviously the Friday was a very flat day with hardly any movement at all. And even that single day contributed to bringing down what had been the previous day's realized volatilities in the mid-12s to a settlement in the low 11. The 3-month December, which isn't affected quite as much by a single day of flat activity, went out at 1284, but those are traditionally, historic levels of where euro volatility usually comes in. It's interesting, of course, that the price movement of the euro has been really sharply lower, but apparently doing it a little bit at a time and not with great volatility, because for a long time there was a 131 level where technicians were saying if that were breached, we could go substantially lower. I think we printed about 129 either today or yesterday, and now rebounded a little bit. But interestingly enough, it seems as if that decline from what were certainly higher levels in the previous months was not really like a precipitous one, and therefore the actual realized volatility of the euro wasn't all that great last month.
That will come to a surprise to a lot of our listeners who maybe don't follow the euro that closely, but anecdotally would have thought it would be a very busy, very volatile month for the euro.
And actually, interestingly enough, the 11.12 settlement for the December contract, and don't forget that's actual volatility. That was the 1-month volatility realized of the euro historically, was one of the lowest that we had. So again, except for when we first started out at the beginning of the year where we were getting single digit 7, 8, and 9 type of volatility, this was actually on the low end.
All right, thank you for that, Don. And now we're going to close out our volatility review and roll right into the Volatility Viewpoint.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
All right, and I love that open because it gets me in a island frame of mind for some reason. It's very festive. And this is, of course, the Volatility Viewpoint segment where Don and I bring on some illustrious guest from the world of derivatives, and then we pick their brain under the hot lights of our interrogation room. Today's willing guest / victim is Professor Stephen Figlewski. He is a professor of finance over at NYU Stern, as well as the founding editor of the Journal of Derivatives, and numerous other accolades and positions that we don't have time to mention here. But Professor, welcome to the program.
Well, thank you. I hope I'm not going to be a victim, by the way.
It depends. Depends the mood that Don is in today. We'll see.
Uh-huh.
No, Steve is, as I told you earlier, one of my heroes for some of his comments about the predictive powers or lack thereof of implied volatility. And we'll get to that paper that he wrote some time ago, perhaps a little bit later.
Yes, Stephen, we definitely wanted to have you on the show because, as Don alluded to, you are one of his early volatility heroes, and you helped turn him to the dark path of the premium seller that he is today. And
well, I love to hear that.
He is indeed a big fan of your work. But before we even get into some of your research, which I think our listeners will find interesting, you have a relatively unique distinction in the academic community of having also participated on the practical side of the derivatives world, having traded over at the NYSE as well as the New York Futures Exchange back in the day. So that is I think a lot of our listeners will find that fascinating. So what did you trade over at NYSE, just to let our listeners know?
Well, this happened back in the very early days when stock index futures were first introduced, and the New York Stock Exchange wanted to start a contract on their own NYSE Composite Index, and so they opened the New York Futures Exchange, and then they were looking for people to come down and trade on the floor. It turned out that they had required all members of the New York Stock Exchange to get 2 seats on the Futures Exchange, which meant that there were a few extra beyond what people actually needed to do trading. And it made it possible for folks like me to lease a seat for $100 a month and go down and trade on the floor. And it's something I'd always wanted to do. My very first experience with finance happened the summer after I got out of high school. Before I went to college, I got a job as a runner on the floor of the Chicago Board of Trade. And I always had a taste for, floor trading. I thought it would be really interesting. And the fact that it became possible to do this without, paying $300,000 for a seat was really an exciting possibility.
I didn't know you came from the Chicago pit community as well.
Well, no, but see, that was when I started, right? But then I was at NYU and was able to join the New York Futures Exchange here in New York. 2 of my colleagues, also on the finance faculty, were doing the same thing. So Malcolm Brenner and Bill Silver, all 3 of us were down there at points trading futures, trading index futures, trading options on the index and options on the futures. But for me, I found it just a incredibly valuable experience to get a feel for how markets actually worked beyond what we say they should do in, theoretical markets with no frictions and so forth. I learned a great deal about it, including things like limits to arbitrage that influenced the work I did after that a lot.
And that's very interesting because a lot of our guests come on and we discuss a lot of the theoretical underpinnings of volatility and the marketplace and all of the efficient model theory and all of these grandiose assumptions about the marketplace. But as you know, from having been down there, once you get down there, these assumptions tend to fall by the wayside and things tend to move very differently than they do in the theoretical models. And so it always is informative to have spent some time in the grist of the mill, as it were, and really see how the sausage is made, to mix my metaphors completely.
Mm-hmm. Yes, I think that's right. As I say, I made a lot of difference to the kind of research that I do and the way I have thought about markets ever since.
Well, let's get into that research a little bit then, because you do have quite a wide swath of research to discuss here. I think most of it will be very interesting to our listeners. But before we even get into some of these specific papers, I know one of your main focuses over there, and indeed one of the main focuses at Stern, which I think is very interesting, is the ongoing derivatives research project that is sponsored by Nasdaq over there. So why don't you give our listeners maybe a little bit of an overview, because that is such a wide-ranging project, of what you really are focusing on with the derivatives research project and what some of the main areas of study are with that project.
Well, the idea of this started off as all kinds of research centers at universities do. Somebody is interested in bringing in outside funding and outside participation into an area of, one hopes, common interest. In my case, I've been a derivatives guy from the very, very beginning. This is my entire professional career has been devoted to looking at one after another different aspects of this whole area. So back in the day, probably 15 years ago, I thought it would be really good to have a center here devoted to study of derivatives. And I spent a number of years going around talking to friends and so forth, trying to raise small amounts of money in order to put on conferences, in order to sponsor original research projects here, in order to do anything really to promote interest and work on derivatives. And I think of derivatives as being a very broad topic. So, futures and options and all kinds of exchange-traded things, plus all kinds of securitized products. So, it's a wide area. And, my feeling has been it's all interesting. And to the extent that we can support, work in this area, that's all to the best. In 2005, Nasdaq came, and they became our major sponsor. They've been extremely generous over the years, and it's made it possible for us to do all kinds of things. One thing that I bet I would hope anyway, that your listeners will be interested in is that we do a number of conferences, big ones and little ones, and little teeny ones sometimes over the years. You told me that at the end I could throw in a couple plugs, but maybe this would be a convenient time to do it. We have a couple of conferences coming up in the spring semester of 2012 that people might be interested in. One of them is that every year I put on a thing which I call Research Day, and I just get this finance faculty here at Stern to come in, and a dozen of us spend 20 minutes talking about what we're working on, and invariably the audience gets amazed at, gosh, you have a lot of people there. We're all really working on interesting stuff. This is terrific. And I always have to say, well, yeah, but you've only been able to see a third of them because that's all that we had time to talk about. Come back next year. And that Research Day is coming up Friday, February 3rd. It's open to the public. We'd love to have you. Another one that I would expect your listeners will be very interested in, it's not something that's put on directly by the Derivatives Research Project, but it's partly sponsored through the Nasdaq grant. It's an annual conference on volatility put on by the Volatility Institute, which is a similar kind of research, mini research center run by Rob Engel. And everybody knows, I think, Rob Engel, the inventor of Arch and Garch and Nobel laureate.
Yes, and a previous guest on this show as well, so our listeners are very familiar with him.
Yeah. Now, his Volatility Institute puts on a whole day on volatility research, and that's coming up on April 27th of this year.
And I was fortunate enough to attend that last year, Steve. It's just a marvelous assemblage of some of the foremost scholars in the field, and the papers and the presentations go on all day long, and it's really a great experience.
Mm-hmm. And then one last thing that I want to let people know about. This isn't something we do every year, but it's one of the major events that the Derivatives Research Project does. Is a conference that I've over the years been calling, the state of the art. So Derivatives 2009, the state of the art, and I try to get the highest level people that you can possibly get to come to this. And I've been every year, every time I do it, absolutely astonished at the caliber of people that come. The last one had names like Engel and Myron Scholes. Darrell Duffy, who is, if you know the academic area, he's brilliant guys out there. Bob Schiller, John Hull, Alan White, Renee Stoltz, who was 15 years the editor of the Journal of Finance, Jim Overdahl, who was the chief economist at the SEC, and all of these people came on, and plus several others, and gave a spectacular conference. And one reason to mention this is that I wanted to just let everybody know how they can find out information about this. And I think the easiest way to do this, these are information, notices about future events, how do you sign up if you want to attend, and also videos for ones that we've done in the past, including the one I just mentioned with Engel and Scholes and Duffy and so forth, are all available from the Salomon Center website. And the easiest way, rather than try and give you a long URL, the easiest way to find this is go to Google and Google Salomon Center, SALOMON Center, and we come up, I think we're the number 2 listing there. And so that's the main website, and then on that website you can navigate to the Derivatives Research Project, the Volatility Institute, and notices about all of these future things, plus videos from all of the presentations at the 2009 conference I just told you about.
Well, I'm glad you mentioned that, Professor, because actually I was going to ask you about that, because that is a big part of the Derivatives Research Project is, of course, that every 3-year conference you put on where you do bring in, like you said, the state of the art to talk about all of the leading research and analysis and developments in the world of derivatives. And I can't think of something that would be more interesting to our audience than something like that. So if you are going to be in New York, or by all means, you just check it out on the web, look at some of the videos, and perhaps even audio that is available out there for some of the panels. I think it'll be very interesting for our audience. So I'm glad we were able to get that plug in early, because that is an interesting one. And I can hear him biting at his nails right now as we speak, Steve. So we have to let him ask you about this. I know Don has been chomping at the bit to ask you about a specific paper of yours that really set him on the path to the dark side many, many years ago and was very formative in his early career. So Don, by all means, I will let you ask about this one.
Well, the fact of the matter is that I had been on the proprietary trading desk at Morgan Stanley for a number of years, and the debates were always raging for the predictive power or lack thereof of implied volatility of options compared to using historical data and realized volatility, which of course is the basis for the Arch-Garch models that Steve mentioned with respect to Rob Engel. And then one day, all of a sudden, came this landmark paper that was well over 100 pages, as I recall, where Professor Figlewski had undertaken to study just about all of the various methods of predicting future realized volatility that were prevalent or were known in the marketplace to that time. And of course, I'll let Steve really take it from here, but there was one striking conclusion in one section of the paper. Perhaps he softened a little bit since he first wrote it, but it'll be a great thrill just to hear you say it, Steve. There was a conclusion at the end of the section of option implied volatility as to the worth and the predictive value of options implied. And what was it that you found then, Steve? I'm going to be excited to hear you say it.
Well, I hope you don't get too excited, Don, because the conclusion, this came from a paper that I did and published in the Review of Financial Studies in, I think, 93, with Linda Kanina, who was, she did her PhD work with me, and we wanted to look at the assumption that pretty much everybody believed at the time without ever actually testing it, which was that markets are efficient, markets are very good at processing information, and we can pull out the market's volatility forecast from option pricing just as the implied volatility. And so no point in bothering to go try and model volatility, look at past volatility or anything like that. All we have to do is get implied volatility from the market. And we felt that, that was really worth testing. And so we took the most actively traded option at the time, which was on the S&P 100 index, the OEX index, and just did a simple kind of a test of looking at implied volatility, running a regression of volatility between volatility up to expiration day as a function of implied volatility from the option price. And what we discovered was that instead of implied volatility being the best possible forecast of future volatility that actually would happen, we found that in that particular case, implied volatility had no information whatsoever about future volatility.
Isn't that lovely to hear?
Don't you like to hear that? Yeah.
You're making Don's day right now.
Yeah, just as a matter of, how academics works, that paper, I think, has been the paper that I've done in my whole career that got the most interest in the profession. And what you see is, if you look at something that everybody believes and you show that they're wrong, they will turn themselves inside out trying to comment about your work and showing why you're wrong. And so you got lots and lots and lots of work in this area that you're interested in. But what I want to make people clear on is that although that was our conclusion, and I felt that it's the correct conclusion for that particular market, and I felt it was very valuable because it moved the profession away from this idea that you don't even have to think about it. Implied volatility is, questionably, how much information does it have? Is it a biased forecast of volatility or an unbiased forecast and so forth? But what I felt then and have felt ever since was that was really a polar case. That the way the market's volatility estimate gets into prices is because people are ready to do delta neutral arbitrage in the market. And when you think about that particular market where you have to be delta hedging and rebalancing a position that involves a portfolio of 100 stocks, that's not a trade that people do much. And therefore, the forces to put volatility into option prices were pretty weak compared to all the other things that move the market around. But that in other cases, in most cases, that we expect implied volatility to have information about future volatility, but it's not an unbiased forecast. It's something that you have to kind of tinker with and modify for a number of different reasons. But in any case, that we felt that the result that we had, that there was no information in implied volatility, that was very unique to this one special case, and that usually implied volatility does have information, but it's not. You don't just take the number. If implied vol is 30%, that's not what the market really thinks is going to happen. That's a modified value that includes a risk premium.
Right.
Historically, implied vol is higher than realized vol, and that's normal because people don't like volatility, and so they will pay up for options that will give them a good payoff if volatility turns out to be unusually high. So that, in fact, we would normally, now as we've thought about it further, we would expect that implied volatility will be a biased view of what the market really believes.
So you think those results would have been a little bit different if you had chosen perhaps a little bit more easily replicable and interchangeable underlying, like let's say an IBM as opposed to a basket of 100, which was the OEX was at the time? You think those results would have been a little bit different?
Absolutely. Absolutely. People have, as I said, people, as soon as they saw this result, they started saying, well, surely those guys are wrong. We've got to prove them wrong. And they started looking at things, and the test is a very simple kind of a test. You get data on a forecast, and you get data on the realization that goes along with that forecast. You run a regression. You regress the realized value on the forecast, and if the forecast really is a good forecast, that regression is going to come up with a coefficient on the forecast of 1, and a constant term in the regression of 0. Right? So that's what you'd like to see. We found it the other way around. We found that the regression coefficient on implied volatility was 0. That had no explanatory power. But when you do that same regression with different options, different underlyings, especially the easier it is to do that arbitrage trade, like, for example, between a futures option and its underlying futures contract, that trade is really easy to do. That implied volatility becomes a lot more useful as a forecast of future volatility, but you never get a coefficient of 1. The coefficient is more like about 0.7 or so. So other markets, other time periods, you don't get that real polar case result that we got, but you also don't get any kind of support that implied volatility really is the market's best possible forecast of what volatility is going to be in the future.
And of course, I remember.
So that's my conclusion from that research.
And I remember the paper very well. It was sort of like you were an equal opportunity dissenter because you were actually a little disappointed in the overall conclusion, in sort of a search for the holy grail of what would be the best predictor of volatility. What you wound up finding were the pros and cons and a lot of weak points in all of the methodologies, including Arch-Garch, where your first take was not all that kind, but as I recall, you kind of softened your opinion a little bit over the years. So maybe you'll talk a little bit about that aspect of the paper as well.
Sure. Incidentally, we're actually talking about two different papers. One of them, the one I mentioned with Linda Kanina, that was published in the Review of Financial Studies. The one you first mentioned, though, is a monograph. It's 150 pages long or something like that. That was published as a monograph, but it's available on my website. If anybody's interested in looking at it, you can just download it off of my website. And the easiest way to find my website is Google Figlewski, and I think I'm the number one. My website comes up number one. There aren't very many Figlewskis out there. But the problem with Arch and Garch is that the model is inherently a model of, what's the volatility over the next day. But if we want to price an option, we need to know the volatility from now until option expiration day, which could be several months away. And the forecasting ability of your Garch model goes down quite rapidly after you have to forecast multiple periods ahead. The whole model is designed around predicting one period ahead. And if you want to predict 2 periods ahead, what goes into your prediction for the second period is your prediction from the first period, which means that the further in the future you go, the more we're still working on just the information that we got today, and the model is kind of running on fumes. It doesn't have enough new information to make good forecasts.
It's compounding the assumptions.
Periods ahead. So that's a problem with Arch and Garch. And another problem that I've found is that the model is, it's elegant, it makes a lot of sense, it's a good way to go. And over the years, you mentioned I've softened a little bit, and I have, partly because Rob Engel is, has in fact been a good professional friend, a personal friend for a long, long time. And he's talked to me about, I see the work that he's doing and so forth. And the models have gotten more and more sophisticated and a lot better able, I think, to capture what's really happening in the market. But the simplest kind of Arch-Garch models, you need a lot of data in order to get good estimates of the parameters of those models. And that was one of the problems that I was having when we explored that in the volatility monograph. I tell people about my poor research assistant. I would come to him and he's trying to fit these Garch models to a relatively limited data sample. And I always, talk about how I come and see him and he's got 2 bald patches on the sides of his head and piles of hair where he's been ripping it out. It's just real hard to get these things to work unless you have a lot of data.
Steve, I've often made analogies for volatility forecasting with, weather forecasting. We're reasonably good at telling you what tomorrow's weather or the next will be. And when you try to do it out even a week as opposed to a month or 3 months, it becomes increasingly more frustrating and, almost impossible. And volatility is almost like that perfect storm where you can do some reasonably intelligent things for forecasting out in the near term, but the minute that you ask just about any approach whatsoever to try to do something meaningful and intelligent out, months or longer, it's just not in the nature of the beast to be able to do that very well.
Yeah, I think you're absolutely right about that, and I think that's a great analogy. It's exactly the same thing.
Now, Steve, since we're on the topic of discussing some of your older papers that may be interesting to our audience and perhaps also could be interesting for a revision or a modern incarnation, you did a paper, I believe it was back in 1999, where you analyzed the model risk that is incurred when you're writing options. And that just seems to me like a very interesting subject. And some of the takeaways from that paper were very interesting and certainly a subject that could easily be revisited in the modern era, given all the developments we have in the options market and in modeling. And of course, if you look at just the subject matter itself, premium writing and options writing has never been more pervasive, has never been more popular, even with the retail side of the audience. It's just become a very, very widely held viewpoint in terms of options trading and a very popular technique, even with Don here, who is a very popular premium seller himself. But yeah, I think that's an interesting paper, and maybe we can hit on some of your quick conclusions from it, as well as have you ever thought about revising it given all the new data and developments we have right now in the options market?
Well, what I tried to do in that paper was to say, suppose that you're in the business you're making markets in over-the-counter options, and so like you're sitting on a desk and somebody comes into you every single day and wants to buy $100 worth of premium, and so that means how many options are involved depends on whether they're in the money or out of the money and so forth, and so you do what you take the other side of that trade, and then you start delta hedging it using. In both cases, both pricing the options you're going to write and hedging the ones that you've done using the Black-Scholes model and your best estimate of volatility to that point. What does that trade, what does that business look like in terms of expected return and risk? Now, inherent in the Black-Scholes model is if you're doing that and if you're rebalancing often enough, you should earn the riskless rate of interest and have no volatility, no standard deviation, no risk in that trade. It should be a riskless trade. That's where the whole Black-Scholes model comes from. So I said, well, suppose you do it every day, but you're facing the problem that you can only rebalance once a day. You can't rebalance every nanosecond the way the model sort of envisions. And you have to use an estimate of volatility because you don't know what volatility is going to be. But you're using the best estimate you could have made at the time given what you knew. And the thing that comes out of this is two basic conclusions. One is forecasting volatility is real hard. That the best you can do is terrible. And second, that given that problem and the problem that you can only rebalance every day. So there's a lot that happens within a day that causes problems for a delta hedging strategy. That, well, depending on what your position actually is, but it was certainly possible to find if you're writing out of the money options that you have more risk per dollar in your delta hedged position than you have in buying the underlying asset outright. And so that was a bit of a shock, takeaway, I have to say.
It's not your instant supposition when you first start trading options. It's supposed to be the opposite.
Yeah. Well, I mean, we have this idea that delta hedging, well, in theory, you should get rid of your risk. And if you sit up in the ivory tower and you don't actually think about actual data and people trying to do these trades, then, you might think that delta hedging is all you need. But when you actually are down there doing it, everybody realizes right away that that's nowhere near enough. You've got to be dealing with gamma and vega and all the other kinds of things, and tails separately from things at the money and so forth. Hedging and really managing risk is a lot more complicated and a lot less effective than we may teach our students in the classroom.
Yes, and Don and I have debated quite a bit on this show the ultimate utility of delta neutral trading and delta hedging and all the various complications that go along with it, like commissions and slippage and everything else that are inherent in that process. And we hold it up as this cure-all for the ills of options trading and a way to get pure volatility, when in many respects it is a very flawed process, as your paper pointed out. I'd love to see a current revision of that paper where we take into account some of the additional things that are going on. There are many different areas I think that could be explored within that paper, that subsets that in of themselves could be their own paper. But we are kind of running a little low on time. But before we go, and I feel we're almost doing short shrift to the topic because this could be a topic in an entire show in and of itself. You had another very interesting paper that just came out, moving along to some of your more current research. And the title alone, I think, will grab the attention of our listeners. It was called Anatomy of a Meltdown, the Risk-Neutral Density for the S&P in the Fall of 2008. And what you did in this paper, which I think was very interesting, was you looked at the risk-neutral probability density, which is essentially just the bid-ask quotes, the spectrum of bid-ask quotes in the SPX, and you looked at how it performed during the heart of the meltdown in 2008. So you essentially almost had a quasi-real-time view of how the market responded and reacted to the various systemic shocks that came its way during that period. I'm sure it must have been a very fascinating data set to analyze, and I'm sure you have some very interesting takeaways, and maybe we could share a few of them with our audience before we wrap it up here.
Mm-hmm. Well, this is an area that has been a major research area for me for the last several years. And the idea is that, we can pull out implied volatility from the Black-Scholes model, given an option price in the market and all the other things we can observe directly, like the stock price and interest rate and so forth, we can extract the implied volatility. But that implied volatility is a function of using the Black-Scholes model. If you use a slightly different option model, you get a different implied volatility. But interestingly, if you have a whole set of options, you can pull out not just the volatility, you can pull out the entire probability distribution of where the stock is going to be at an option expiration day, and that doesn't depend upon the model. And so that idea actually is quite interesting. That's the difference between the old VIX index and the new VIX index. The old VIX index took the Black-Scholes implied volatilities and blended them together and came out with an implied volatility number that was dependent upon the Black-Scholes equation. The new VIX index does basically what I just described. You take the whole set of option prices and you extract the whole probability distribution, and you take the standard deviation of that. and that doesn't depend upon the Black-Scholes model, and I think is a better procedure. Now, as long as you have a full set of option prices, you can do this. And so I've been doing this, looking at two different sets of options prices, one daily prices on the S&P index, and also we have a data feed now. We're getting the intraday continuous data from the Option Price Reporting Authority, a data feed, so we can construct this risk-neutral probability distribution at any instant within the trading day. So that's what we did in the fall of 2008 with the data there, and it was just unbelievable you get to take a look, for example, at the left tail of the distribution, and is quite unbelievable how things were being priced in October and November of 2008. Probabilities of total collapse in the market were fairly considerable. I think that we could extract from the option pricing. A couple of things that we found that were just aside from just that this was an unbelievably volatile time period, but we found also looking at these things that the left tail moves more than the right tail does. The left tail is a lot more flexible in the sense the market is going down, the left tail of the distribution, the probabilities of further collapse increase, while the right tail doesn't seem to move very much. If the market's going up, the left tail comes in, and the right tail doesn't seem to move very much. So that's one thing that we found, just as a general rule of looking at this risk-neutral probability distribution.
That gets into that.
I have a number of different projects going on this, and I think they're all pretty interesting. Maybe we should be thinking about doing this again in a few months.
Yes, like I said, this could easily be an entire episode of Volatility Views as we discuss and get into some of the nitty-gritty details of this R&D study and your work analyzing this, because it is a fascinating area. It's very personally interesting to me, having been a market maker in that pit during some interesting times. You quickly realize how imperfect that process is, and the market-making process in general, particularly during times of systemic shock and uncertainty like that, when you have no idea where the underlying is actually trading, let alone where it's going to be in a few minutes. And so your study pretty much solidifies and codifies the imperfect nature of that system and opens it up for all to see. And it's also very interesting, too, what your discussion about the downside movement and the left side of that tail moving far more than the right side, because that's something Don and I have discussed on this show many times in the past, the market's general downside bias and how that is much more volatile and moves much more than the upside risk or the upside tail risk that doesn't really seem to concern the market as much as it does to the downside. Maybe that's because of all the recent literature like Black Swan and everything else, just focusing everyone on that endless systemic risk to the market. But yeah, it is a very interesting paper, very interesting data set. I encourage all of our listeners, if they want to they have a chance to surf on over to your website, like you said, just search for your last name. Is probably the easiest way to find it. It is spelled Figlewski, yep. Figlewski, and that will lead you to, at the very least, abstracts of most of your papers, and people can then go on to download many of them if they want to read more. And Professor, like I said, I wish we had more time to discuss this because there is a lot of fascinating material here. We'll definitely have to bring you on again down the road where we can get into more of the minutia of your work in much more detail. But I want to thank you for coming on the show, and I'm sure Don does as well.
Great pleasure to have you here, and I hope that we can talk about future visits. We'd be honored to have you on the show as often as you'd like to be with us, and we certainly thank you for your time.
Well, I thank you for having me. It's been a lot of fun. I've enjoyed it. And one last thing, incidentally, if anybody does go to the website, there's a couple of movies of how the risk-neutral density moves within a day.
I saw that. They were very interesting. I recommend them to our listeners if they're intrigued. It definitely gives it a different impact when you see it unfolding visually.
Yeah.
Well, thank you again, Professor, and we'll definitely have to bring you back on again down the road.
Terrific. Thanks so much.
And that's going to do it for our Volatility Viewpoint segment. And now we're going to roll right into our Crystal Ball segment.
And now we take a look at the crystal ball.
All right, and welcome to the Crystal Ball segment. This is, of course, the portion of the show where we prognosticate wildly about the future of volatility and VIX and Euro Vol and everything else under the volatility spectrum. And, of course, if you listened to last week's show and some of the earlier shows, I of course, came down the side that VIX was going to, in the very near term, drop below 30. And I think this is definitely, this 23 to 25 range seems to be a much more comfortable, a much more tolerable range for the VIX right here. And this is, quite frankly, right now, this is just a coin flip time for VIX. I think we're going to vacillate in this quote-unquote new mean, this 23 to 25 range for quite a while, I think. And I don't see anything, at least in the near term, really dramatically moving the needle unless something does erupt in the Eurozone again. But I think this is the new home for VIX for the near term, at least, the 23 to 25 range. I don't see us heading back north over 30 anytime soon. And Mr. Schlesinger, what does your crystal ball foretell for the future of the Euro Vol?
This one looks a little bit tough to me. We've only had about 4 days into the January contract. The realized volatility has been decent again at about 14.5, but the contract actually settled at 1332 last night, so people are certainly forecasting somewhat lower volatility than what the first week has brought. So it's pretty much in range with historical levels, but if anything, I perhaps would look for a little bit lower from the start that we've had for this week.
All right, thank you for that, Don. That is going to do it for the Crystal Ball segment. That's also going to do it for this episode of Volatility Views. I want to thank our guest, Professor Figlewski from NYU, as well as Mr. Sebastian. And before we go, Don, give us a quick alert on what's coming up over on volex.us.
Well, let's shift to Bloomberg because I had spoken about it for quite a while, and I'm very pleased to say that we are now live on Bloomberg, and all of our listeners can simply type in VOLX, Volex, and just hit the go button, and you will see our screens and our suite of series and indices and all of the information that can also be found on our website, but is now live on Bloomberg. So we're pleased to announce that. I know I've been also throwing out the teaser for many weeks now, but we do have the legal work in the very, very end of the home stretch with our next venture for bringing out equity vol contracts. And so we hope to have an announcement very shortly in that regard for what will be our next offering to follow the Euro VolContract futures.
Well, that's very exciting. That's quite the tease to leave our listeners with this week, Don. They're going to be wondering all week about what you guys are going to put out next, I'm sure.
Now, that'll be our Christmas present.
All right, Don. Thank you for that, and thank you out there for joining us on this episode of Volatility Views and for downloading and streaming and subscribing to the program and making it such a success. And we will see you next week right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volex.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volex_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.